Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, June
Welcome back
10th,
to Squad.
2022. What I'm going to do is an update on the equity markets and commodities. I want to look at those two things, and commodities really to just talk about inflation. That's what sent markets down today. We had this bear flag. It formed in the futures as well as QQQ. If you look at the after-hour session and pre-market, these candles they get a little wonky sometimes. I gave you the chart this morning, but then sometimes you get these tall shadows that don't really aren't really real trades. That happens on just about all charting programs. I don't know what goes on. Maybe there's some errant trades somebody placed. When you trade pre-market and post-market, you have to put a limit order in, and maybe people are making a mistake typing prices and one order gets filled away. I really don't know what causes it, but it doesn't matter. This is where we traded. This is where the futures were and everything else. And so you have that flag. The flag I measured was that part of the flagpole. Here, let me zoom in a little tighter. The impulsive leg down. One could probably go with that as well, right there. That point if you wanted to, because that's where we started to drop. There was only one green candle along the way, and then you take that line and you add it to the highest part of the flag. Either way, we're pushing even that right now, and there's that big 294 level. Remember a couple weeks back, that was the level that we were basing, needed to break out, and got that explosive rally that I was looking for when that happened. So as I said in my comments today, this to me, all this was the all-in moment, the heavy, heavy long, because of the fact the risk reward was so good. That was when we hit those targets across the board on indexes, key stocks, overshot a couple on the indexes, and then recovered, and that was in itself very bullish. Everything else that was outlined there, even that intraday with little whipsaw. But remember, I'm going to show you big picture, and this is short term that I started out on. And let me just say this: 294 is really that number. Remember that's what I said. My max, comfort pullback target. I gave you all levels along the way, minimum pullbacks and max target range. And 294 was and still is my line in the sand. So I'll say this right now: we're trading below it. So if you got that post today and you didn't act, I would not add now. I would not add unless 294 is recovered. I'm going to give it a little room because like I said, I've been taking it very light, this week, gone half the week, and then just haven't seen any really good. This is really it was this morning, I'll say it, about the last in most subjective area where you can go in pretty heavy and increase positions because, again, your RR, to me, everything's about the risk reward. So if you have relatively tight stops, a problem with giving it, like I said, maybe a two 60-minute candles and I do that because you're always going to get on a gap down. The Q's gap down here. If we turn off all the pre-market trades, it's going to look like this. You can see the gap down. You get order imbalances there, and traders are caught off guard. Stops are hit, and this is why I always talk about trading futures versus the ETFs and individual stocks. Because if you have a stop loss, let's just say you went home and you saw that futures are flagging there last night, and you own QQQ and you have a stop loss order right there. Well, guess when it gets filled? Stop loss orders get filled. They convert to market orders at the open the next day, and they stand in line with everybody else's, and that's why you get those big boom and usually an overreaction. So best to let, especially on a big gap down, to give it an hour or two, and then see once things stabilize to the big boys coming to buy. So there's short term, and again, now if we recover 294, that's going to be bullish. So if you didn't do anything, you're waiting to see what happens today, that you could certainly take it there. But you don't. This is a break under support. There's the measured target of the flag right there. And so we're even a little bit below that. So there's my thoughts right there. And also, if you do, even if you're long or short, either way, remember the Fed is on deck next week, and I'm going to talk a little bit more on that. But let me just loop over to the big picture here and talk about, where we're at. This is the weekly chart. Remember, almost SPY, IWM, almost perfect tags of my second targets. QQQ overshot by just 1 week and then quickly recover that with a solid recovery the following week. And that's when, at the same very time, Amazon to the button, Nvidia, all those key stocks also fell at support. And so that's where I, reverse looked for the bounce. And we did. We've had a bounce. We've had a reaction. I define a reaction as a consolidation and or a bounce when you're going down. When you're going up, it's you hit a price target or resistance level where I expect a reaction. You're either going to consolidate or pull back. That's a reaction. Either or, sometimes it's a combination of both. And it's how you look at it. You can say that some consolidation, absolutely, certainly was from low to high. It was about 12.26%. So again, it's a tradable reaction depending on how active a trader you are. If you're a long-term investor, nothing's changed. It's most likely a bear market. You can ride out counter-trend rallies. But what I was getting at here is just looking at the weekly chart, and what I still think could happen is, we can come up here, and that was a big support right there, about 318.58. So I still think there's a chance we can get there. And look, we're still well off the lows if you look at it that way. 294 is my number on the 60-minute chart. That's all, that's what I was looking for here. When you look at this weekly chart, you're still oversold, coming off oversold readings. You're still making a series of higher lows over the last few weeks. And so from that case, a case can be made if you're, if you do think there's more upside. And I'll tell you, as bad as today looks, I'm still leaning that way. Then you can give it a little more room. You don't, in other words, you might not trade off the daily time frame or even the weekly on a daily or weekly closing basis. So that's it. So QQQ, which is the area I was focused on the bounce, very well still could have another leg up, or this may be it. That's a reaction. We got it. We had a reaction so far, and the $1,000,000 question is that it or not? And when we go back to the 60-minute chart, remember, from back here on the lows, I laid out for you 3 targets. 1, 2 was hit, 3 was hit. We consolidated around 3. So far, there's the reaction. We had consolidation. We broke down from the range. They had a potential to have that be a whipsaw, but it wasn't. So that was, like I said, coiled spring energy. I thought we might have a chance to whip back in there. Now, if we do, it's going to be a longer run up, but you can see that's what happens when you have a pretty well-defined trading range. And the break of that, it certainly did determine which way we go. And it is a bear market, so maybe I should have been more open to that scenario. And I was certainly open to it. I just figured we might go the other way. And again, I just made the case that looking at this 60-minute chart, it gets pretty ugly here. 294 has been taken out. This is a level I had back here. There was a gap. That line isn't very solid support. 291, it was a gap back here, and I really don't even have another trend line. All you have, which you could come into play, there's a downtrend line that we broke above. Remember, we bull flagged right here, broke above it. Maybe we backtest that. So it's not looking great, but the closer we get to those lows, it's a double test of the lows. Anything's possible, but I'm going to go show you a few more things real quick before we wrap up, and then I want to get to commodities. So that's what it looks like on a 60-minute chart. Not good now. Ideally, for the bullish case, you're going to need to see this market rally up and recover 294 today. If not, and the further we go down, the odds increase that we could go even much lower, and then open the door for those targets which I've maintained all along. Nothing's changed there. T3, my next target on QQQ, is the yellow uptrend line and/or, which they should come into, when I say and/or, because they're going to come in together about 268.30. And then T4, that blue trend line, which is also the what I call the pre-COVID highs back there. So there's plenty more downside. I'm just still leaning towards this right now. I think this is probably that last washout move if we are going to run up. And I'm still open to the potential we may run all the way back and test these 200 days again. That would be quite a rally from where we're at now. SPY, the S&P 500, same thing. Slight momentum fueled overshoots of my second target. And you look at this, and SPY pretty much hit what was my minimum bounce target on the weekly here. That big 415.51 level, almost hit it perfectly, and hit it for 3 weeks. Tested it, resistance, support. It was key support here. Broke down. There was our sell signal, follow-up candle, and then boom, the last leg down, and then boom, boom, boom. 3 weeks in a row, we tested it and then finally rejected. So this is kind of bear market stuff, and it is certainly, I'm certainly open to the possibility that that was the reaction off T2 and it's over. And we may go on down, and then that opens the door to my next longer-term target on the S&P 500 down here, 354. And then you have the long-term second target are those pre-COVID highs, and they're not, yeah, and that's why the targets don't line up perfectly because they're two different indexes. We may get down there on QQQ, hit QQQ's pre-COVID highs, and then the S&P may hit this one. We'll see if they come in together, and that's what's probably going to happen when QQQ hits one of its next targets. SPY will be on probably on this one here. When QQQ hits the next target, that is. And then, so again, I'm just looking at bounces. So again, this satisfies what would be a minimum expected bounce or reaction off T2. The fact we come back to that really good level, which to me was, that's why it was color coded yellow, was big support, and important support becomes important resistance once broken. If we can power back up, maybe another run at it, maybe even the 200 days, certainly possible. But once we start taking out these previous lows, those other two candles there, the odds increase that the counter trend rally is over, and that's where we go. IWM small caps also did the same thing. They hit their second target up to the almost to the button there. Traded on it for about 3 weeks, bounced, and that was the big level back there. Remember, 192 was my first target here. We hit that. And so again, pretty much the minimum targets on everything but the Qs have been hit. And the Qs I figured would bring in more buyers because they got beat down more. But, well, that's not happening today. We'll see if it does. And one sector to watch, too, is the semis. Remember, we were short the semis on the way down as well. Was overweight that sector. T1 was hit 1, 2, 3 successive weeks, and the bounce also took us up back to what key support I had there, 435. 1, 2, 3 weeks, and we've come down, but we're still at this point in time. We have 1, 2, 3, and now 4 higher lows. Again, the week is not over, but it's Friday, so they'd have to really build on this drop. It's already down 2.9%, so we're probably going to close the week. My guess is their buyers are going to step in today. I'm just telling you what I'm figuring on. We'll see if it doesn't happen. This is what it looks like on the daily. Remember, and one reason that I continue to lean towards another leg up is this is a daily chart, and this is what the QQQ looks like. We have big positive divergence on the daily time frame. Yes, you have to counter that out with the fact that we're in a bear market, or what I believe is a bear market with more downside to come. And therefore, these bullish falling wedges and positive divergences and all these bullish technical developments don't mean nearly as much or don't carry as big a weighting as they do in a bull market. So, bear markets are full of nice bullish setups, just like in a bull market. Bearish setups arrive, bearish wedges and head and shoulders and bearish candlesticks, and they just don't play out, or they play out for very little, very small drop that gets then bought up aggressively. But all right, so with that being said, we broke out of the wedge. We've had the initial thrust up, and again, corrections usually manifest in at least a ABC, a three-wave pattern. So if you look at the and again, you want to get nitty gritty, and I'm not an Elliott statistician or whatever they call themselves, Elliott waver. You could look at other counts in there. I'm sure there's different waves, but after the wedge broke out, we had some bottoming here. It appears this is the first thrust up, and we could get one more. I'll tell you what it's going to hinge on, and I don't expect anything big to happen, even on the downside between now and next Wednesday at 2 p.m. because the Fed's on deck. We got our inflation numbers. They were hot. That's what knocked the markets down. That's what took the futures down out of the flag today. But as far as the semis go, again, so far, you're making some higher lows here and higher highs. I mean, it has the potential, or it is the early makings of an uptrend. I don't think it's the bottom, the end of the bear market, but that's what it is. If you want to just be completely objective, that's what that is. You had a run up, pulled back, made a higher low, another run up, a higher high, and then a pullback. And so far, and again, the day is young, but so far a higher low. So if they can reverse, we'll probably get that last thrust up, and that could run at the 200 days. So the possibility is still there, guys. 294 was a big level to me. It's been taken out as of now. We'll see if it gets recovered. If it does, you could see a pretty powerful short squeeze, short covering rally. And if it doesn't, likewise, you could see forced margin selling start to kick in, and people unwinding long positions that took the bounce, myself included. I'll be in there. But again, I'm not. You can't bet the farm now in front of the Fed. Plus, this week was just a really not. Well, at least for me, not even being in front of the computer for the first 3 days, just not really a week to be actively heavy, long, or short, just about anything. All right, I'm going to move off that. I pretty much made my case. Where what I think is still probably going to happen. Those flags, certainly, like I said, don't help the bullish case, but they don't eliminate it, if that makes sense. All right, so let's look at commodities. I think a big move is coming on the downside still on natural gas. This is UNG, the natural gas ETN. It has been, like I've said, extremely resilient in spite of these divergences, but it's not as if they don't work. That was DH1, divergent high 1, followed by a strong correction. And then we made another new high, a marginal new high with a still divergence in place, in another correction, and now all I do is extend just recently, just even a less marginal. What I mean by less marginal, this one was a little, noticeably higher. This one was incrementally slightly higher, followed by a lot of selling so far, and it was just basically, I need to make that DH3, duplicate that and just change it, edit DH3. And why is it DH3 1 2 3? Because it's an extension of the same divergence, not a new, separate, distinct divergent high. It's an extension of the negative divergence that's been building, and you'll see the same thing on natural gas futures. UNG does a pretty good job of tracking the futures, and you can see I have pretty decent, not great, but decent support there, about 27.54. It seems to have held there. There's a big old gap back there, so that's the level we need to get taken out. And I'm still maintaining this target down here, this long-term uptrend line, and or that 1958 level, which would be, well, those are old notes from May 6th. Today's the 10th, but we're still looking at roughly, about 33% or so. Okay, and so that's what's priced in there. The other thing is USO crude oil. Again, resilient it would be an understatement, but that's what it is. Extremely resilient in spite, but these divergences grow. I didn't queue up for this video. I should have opened up my stockcharts.com. I have WTIC, West Texas Intermediate Crude, long-term charts, weeklies, and all that. Same thing. We're seeing these extreme overbought conditions, divergences, things that we've seen in the past. And I don't know whether it's going to be a fundamental headline that's a catalyst. Russia's starting to want to play nice now. Peace talks, something will happen, and it doesn't matter. Usually it's the technicals will set up the move, and if there's not a headline that accounts for once we break, what has to happen technically is we need to break this minor uptrend line in crude here, and then come down here, and that's a big level right there, 82.32. Why? Because you had this trading range here. Boom, 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 boom. Just like the little trading range we just had in QQQ. The break was to the upside, which is bullish, and it could be the catalyst that we just burned through these divergences. But, this is it, but if we fail that level, that breakout, that's going to be a very big bull trap, i.e. false breakout. And that would have bearish implications, and we could come down quite a bit. So we'll watch this until the inflation trade breaks, and these are the king of the inflation trades right now, these energy commodities. Then the Fed has no choice but to be aggressive and continue to raise rates. Finally, I'm going to show you the one that I've talked on for a couple years now, where Powell, playing dumb, and finally coming and admitting, we underestimated inflation. It was easy. This inflation didn't come out of nowhere. When the Fed hit the nuclear button back here, as well as the federal government, with both monetary and fiscal stimulus, it was clear to see. We knew at the housing market, you didn't have to wait for CPI data and other lagged, dated reports to come in. We knew what was going on. If you buy your own groceries or do your own shopping, you knew the prices of things and the things being out of stock. Or you could simply, and this is what you want, a real-time measure of inflation. This is the one I talk about, DJP. It's a well-diversified commodity ETN. I just updated the holdings this morning for you because, last time I had it was February 26th. So I did it as of today. Here's the weightings right here. It's now 13.7% natural gas. Back then in February of 2021, it was 12.4% gold. Crude was second place at second holding at 9%, and then natural gas is 7. But you can see what happens when those have big run-ups. So now we have almost a 14% weighting in natural gas, 12% in gold, 9% in WTI crude, but another almost 7.5 in Brent crude. So combined there, you're looking at over 16, close to 17% in crude oil, and then add that in with natural gas, and it tells you right here. These are index sector weights: 39% energy, 22% grains, oil seeds, 15, almost 16% precious metals, 13% industrial metals, 6% softs, and then 4.5 livestock. That's why I like this ETN, because it's pretty balanced. Some of the others are a little too over skewed, and energy is a big component, and energy will have one of the biggest impacts on the CPI, bigger than a lot of these other things. So therefore, we're going to watch this, and when you look at the chart, there's a big drop coming. And it's the same thing because you have those divergences on crude and natural gas. It looks like it's priced in. We had a nice cleanup trend line there. It broke, it back tested, and what we're doing now, we're putting in the momentum is slowing. You can see there was a major blow off type top. We went up, took it out with a marginal, meaning a very slight higher high, and then once again, an ever so slightly higher high. And so what that shows is this is when the momentum's strong. This is when the trade was, bulletproof. But it's starting to weaken, and that's what these momentum indicators tell you. That's what they are. They're momentum indicators. They tell you the momentum is waning, and now they are not divergences. Negative divergences are not a sell signal. Positive divergences are not a buy signal, but what are sell signals are breaks of support, things like that. So we'll watch. You got a little minor uptrend line here, and really when you see crude and nat gas break those levels I talked about, that will most likely prick the inflation bubble. I'm still longer term bullish on commodities. I fully maintain that we, as I said, just ended a bear market back when COVID hit. Commodities have been in a multi-year bear market, and they're still well below their highs. And this was when we didn't have runaway rampant inflation. So I do think over time the commodities are going a lot higher. Please don't get me wrong on that. It's just nothing goes straight up forever. There's going to be corrections along the way. And so now, where am I going with it? All this is kind of line up. These charts are set up that if the Fed, they're going to do what they're going to do. I didn't even listen today. I haven't checked. You can Google Fed funds futures, and they give you the probability, and I believe it's another 50 basis points we have coming. I haven't checked, but whatever it is, it'll be the Fed does no surprises. It's about what they say. So if they had all backpedal, and the markets are throwing a hissy fit today, and they've been throwing a hissy fit, and if they continue lower, the bottom line is the Fed may, again, they're not going to change what they're going to do at the next meeting, but it's what they say. And if the market perceives them as maybe softening a little bit on their hawkish stance, which I suspect, if you want to, I like to sometimes ramble and try to guess fundamentally what's going on. I'll bet you there are a lot of big pension funds right now, a lot, including CalPERS, the world's largest in the country, and really pretty much probably the world, that are in the Fed's ear saying, we are going to blow up. There's going to be a major crisis. We were too heavy in equities. Yeah, we got caught, their hand in the cookie jar. We thought the free money party would go on forever, and we're going to blow up, and we're going to need federal assistance. That's what's down the line here. They've already been grossly underfunded for many years now. They were trying to play catch up by going too heavy into equities. And so things like that, and that's where political pressure comes in. And Powell who knows what Powell's thinking? Because again, how he didn't see this inflation coming until right here is when he pivoted in November. Is when he started pivoting in rhetoric, but not into actual rate hikes until earlier this year. Um, but where I'm going is, yeah, they may recognize that the drop in the stock market. I don't know if he'll say these words, but the drop in the stock market, that what that does is it takes away consumer confidence, and therefore consumer confidence, consumer tucks in their shell a little bit, consumer spending declines, and therefore it's a vicious cycle. In other words, the fact that the commodity bubble still rages on, the stock market, the more it goes down, the more it's going to, by sheer force, cool, at least slow the rate of inflation. Because, again, consumer spending, here's XRT, the retail sector ETF, retail stocks down almost 44% since their peak. That's obviously a good part of that pricing in the slowing consumer demand. And I think the Fed's going to recognize and anticipate that. And at some point, again, in rhetoric, that's all the Fed is really about most of the time nowadays. Unless they reach extremes, they try to jawbone the market up and down with bullish or bearish speak instead of actions. Again, I know they're finally hiking because they're no choice. They look like idiots. They have egg all over their face. But anyway, that's what we might see now if we do. Again, why is it all lining up? Because what I just showed you in the stock market, we're still off those lows. Maybe it's just another run at those lows, and there's still the potential on a lot of these charts. When you look at the daily chart, that this could be, when you look at SPY, for example, the S&P 500, there was our downtrend line. There was our big divergence right there. That was our second divergent low right here on the PPO. Remember, we had DL1, divergent low 1, but we've had the RSI divergence building. And, I've mentioned there's certainly some negatives in there. I can make a case, like I said, if I want that this is it for the rally. But it just doesn't appear that way. Again, this looks like the first wave up after the breakout, with including the breakout of the bullish falling wedge, or that downtrend line right there, followed by some consolidation, correction, and this would be, we could get a wave C up that would take us. There's the 200-day exponential moving average, and there's some price resistance. So this is a scenario that at this point in time, I am still leaning towards, but I am not married to. And so when you look at it this way, this is ugly price action. But again, you have the Fed coming up. I've seen the market throw bigger hissy fits in front of the Fed, so it could just continue on down. Anything's possible, guys. I'm just telling you what I think are what is most probable. That's all. And this is certainly a possibility that cannot be ruled out. So trade as you want, or don't trade. Keep it light. FOMC meetings on Thursday or Wednesday. Who knows what they meet Tuesday and Wednesday. The announcements at 2 p.m. Who knows what they're going to say or do? Again, I try to get myself in the head of the Fed, but if I was Powell, I would have never, even if I want to play Monday morning quarterback and criticize what the Fed going overboard, doing too much, and the federal government back then, sure. In hindsight, anyone can say anything. It did appear to many like the world was coming to an end, so I get it. But the fact that they did not take their foot off the gas pedal at that point and start tapping the brakes until right here, that's where I don't even know what this Fed thinks anymore. So anyways, I gave you my thoughts, what they should be thinking. And that is the fact that the stock market has done a lot of the work for them, but it just takes a little time for that to permeate. Consumers starting to pull into their shell, housing market cooling off, lumber prices have abated, and other things. So let me get the video out to you guys. You have levels to watch. You kind of know that the next few sessions, today's Friday, but of course Monday, Tuesday, Wednesday, are going to be pre-Fed meetings. And then, as always, I say this time and time again, the initial reaction to the FOMC meeting is usually not the lasting reaction. It's going to take a day or so for the dust to settle. But watch these recent lows. Watch today if you want. Watch to see if there's a intraday reversal and a recovery in buying, or if they're just the buyers have dried up and there's none out there now. If we can't recover 294 soon, especially by the end of the day, you want to give it a little room, then that's not good, but it's not the end of the world. But it's, again, it's not good. We start taking out those previous reaction lows, there's just not much, there's really no support until the next levels that I have down on the weekly chart that I started the video with. So that's where we're at. I'm going to get it out to you, and I will do a follow-up later today for sure, depending on what happens over the next few hours. This has been Randy Finney with Right Side of the Chart. Have a great day.